Good afternoon. This is Brian Shannon from AlphaTrends.net. Today is Wednesday, the 19th of March, 2008. The market's closed, and we get back a good portion of yesterday's gains here today. Again, this market, if we're going to find a bottom, it's not going to be one day at a time. A bottom is a process, not an event. A lot of times there's news that comes out that starts that bottoming process, but the bottom is not an event. I've got a few people that are getting a little bit argumentative with me in the emails about insisting that it's an event, but clearly it is not an event. It's a process that's sometimes motivated by an event such as bearish stearns. But you cannot look at this market and say it's made a bottom. None of the signs are there, especially with this, again, the still declining 50-day moving average. Yesterday, we're starting to see some encouraging signs that maybe this market is turning neutral, but when that 50-day moving average is still declining, we've still got a declining 50-day moving average, you have to remain very suspicious of any rally attempts. When we look at the 30-minute time frame, you can see the market came right down to that 5-day moving average, barely holding above yesterday's lows that were made right after the Federal Reserve. And you can also see that this is a VWAP moving average of the last 3 days. So for the week, since we had the Bear Stearns fallout, the market on average is pretty much neutral as far as new participants in this market. You can see that there is an uptrend to the flow of funds basically in the market, but it's coming down and testing that level right here. So it remains still a very hard-fought battle here between the buyers and sellers. What we're looking at yesterday is, first of all, we saw that this downtrend line was broken, and that didn't hold. Obviously, we can see that, and we came up and tested the highs from March 5th, but also this level is important on the daily time frame because it's also the location of that declining 50-day moving average, and it's not good to see that the sellers came in so aggressively in there again. So a lot of mixed messages continue to be broadcast from this market, and with the primary trend lower, you've just got to be very careful on the long side trades and listen to the message of the market. Today here we had a downtrend early on. Looked like the buyers were going to come back in and try and hold this market up, but from there it was pretty much lower highs and lower lows. Another rallied attempt right here, which failed late in the day, and that brought on the next wave of selling. So just a lot of mixed pictures, but when you look at the weekly time frames, it's still a big mess. A lot of people are calling this a double bottom. You don't know till well after the fact what a double bottom is. Go back and look at your technical analysis books, because a double bottom is marked by first a low test of the low, we'll call that point A, a rally that up to, in this case 140, that you call point B, a retest of that low, a break of a trend line, and then once it moves past that 140 level or point B, then what you do is you take the height of this pattern and add it to the break of this point right here, which will give us a price objective up near 155. We don't have a double bottom in here yet. You won't know that for till the market gets at least past 140, and it's got all these other obstacles in the way before it gets there anyways. Again, it's a very important level here, I think, is the VWAP from the January lows, the volume weighted average price, and you can look at the VWAP since the beginning of the year, pretty much came right up at that level as well. So for the year, the buyers were close to getting negative, going positive or gaining back control, but were unable to do so. The average price since the January lows is right now at about 133.50, and if you notice, that level's been coming down over the last couple sessions as well as we trade more volume at lower prices. So the market remains at a very critical juncture. Best case scenario is that we're in a stage 1 neutral bottoming process, but again, you can't say that yet. We're going to need to see some higher highs followed by higher lows. The 140 level is going to be, again, an important level on the way up. Once if we can really, this 135 I think is very critical. So if we can get and hold above 135, the 10-day moving average crosses above the 20 gets above the 50 flattens out, then we can have a rally that might hold on, but it doesn't mean that we've made an ultimate bottom in here. Let's take a look at the home builder index, because this is a good example, the XHB. This market, tried to make a bottom in here last year, and we saw that the market got above the 200-day moving average, but the 200-day moving average was still declining as it attempted to break out there. Now we've got another, what's looking like maybe, let's see, XHB is a symbol. What's looking like, just more neutrality in here. These home builders are still in that bottoming process. People don't even care about these home builders anymore, and that's what happens during the bottoming process is people stop, they start to give up. It just kind of quietly sneaks up on you. I'm not saying that the home builders have bottomed, because we still don't see that sign yet. We've still got a declining 40-week moving average in there. So this market's still going to take time, and the S&P will take time too. The market, bear markets are best left for, as I've been saying, the most aggressive, disciplined, and experienced traders. This is a trading environment. I like what Howard Lindzen had to say about, a week or so ago. When you sell short, you've always got to have one foot out the door. You got to be ready to cover quickly, because these huge rallies in here, 3-4% rallies, and what has the market accomplished with those 3 and 4% rallies? It's accomplished absolutely nothing here over the last 2 weeks. So it's a churning, bottoming process. Again, big volume without further downside a lot of times indicates accumulation. So maybe it's part of that bottoming process, but we won't know until it enters a stage 2 uptrend once again. Something that George Soros says as well is volatility peaks at turning points and diminishes with trend. Well, perhaps this is a turning point, because we're certainly seeing massive volatility in here. And I'm not talking about the volatility index. I'm talking about the percentage of moves and the frequency of the moves that we're seeing in here. The XLF yesterday, I said maybe we're reaching an intermediate term bottom as we flushed out the sellers with that bad news. I think that looking at the XLF, that these, if we get back down towards 23.5, then we could see a whole nother round of selling once again. So maybe we've made an intermediate term bottom. Doesn't mean go out and buy. It means now we can begin some of the healing process. Like I've been saying, this 26 to 26.20 level is the key level of intermediate term resistance. That's where we had this prior support where we really broke down hard from. And now you could make a case, well, maybe it's making an inverted head and shoulders pattern. We'll see. It's good to see that it remains not well above, but 30, 40 cents above this 5-day moving average, which is starting to get a little bit of an upslope to it. So we'll see if the buyers can come back into this market. And again, the S&P 500, I think that closing this gap and getting back below there, then you're going to see perhaps another round of selling as well. So just a lot of mixed messages across multiple time frames. The IWM, the Russell 2000, let's take a look in here at the volume weighted average price. We'll take a look since the January lows right up to basically where we've been coming up to is the $69 level since the beginning of the year, just above that. And you can see that again, this market found resistance, or found a source of supply to halt this upward movement where it had prior resistance this over the last couple weeks. And that's I'm gonna say that now the resistance is really more $68.5 to $69 level. That's where we're seeing the real selling come back into this market. That's where the supply is being released, and that's also now coincident with the declining 50-day moving average. So the 50-day moving average is coming down to meet these levels, and it just it wears on buyers' confidence, and they people are taking their quick profits when they get them. It's just sending a lot of mixed messages is the proper way to look at this market. There's a lot of indecision out there. So the 68.5 to 69 level, that's where we're finding the selling here intraday. You can see this market came down through that 5-day moving average. As far as the last 3 days, we're the average person over the last 3 days is now losing money in the IWM. So since the Federal Reserve came in and cut interest rates on Sunday night, and then another 75 basis points yesterday, has really not helped the buyers. It's helped, we've basically got a Band-Aid on the wound, but it's still bleeding. It's starting to see the first trickles of blood through that Band-Aid right now. The market remains a mess. It's a bottoming process, and we'll see what time gives us. But you've got to be very aggressive in this market about trading either the long or short side. If you're used to being an investor, you've got to be better at looking at more time frames and listening to the message of the market. The message of the market is a buy and hold investor here is going to get nothing but an ulcer basically from worry, all the worry that it's giving you. But if you're able to objectively look at the short-term trends and see them develop, and in here, on the 1 minute time frame, the sellers were pretty much in control all day except for just a few moments near the open. So a lot of problems still remain in this market. The NASDAQ 100, you can look at this trend line here on the daily time frame and see that it seems to be holding. This market can't even bounce up to its declining 50-day moving average. So clearly the NASDAQ 100 remains the weaker group. We're seeing encouraging signs, but then, as soon as you get your hopes up, the market just comes back down again. It keeps testing this VWAP, and again, I think that the VWAP from the January lows and from the beginning of the year are going to be important levels going forward for all of these markets. If they can get above and hold above those levels for more than a couple days, then we can start to the psychology shifts, because more people, the average participant in the market for that period of time is now making money, and that gives them a little bit more confidence. They aren't quite as skittish every time a little piece of bad news comes out. So the theme remains the same. We're in a bear market overall, maybe showing signs of neutralization, but when the primary trend is lower, you have to be very suspicious of all attempted rallies.